We will get started. Okay, good afternoon, everyone. It is Friday, March 8th. This is a meeting of the Revenue Subcommittee of Ways and Means. We have 3 bills for discussion on our agenda this afternoon. We are really just looking to start the conversation about these bills. We have, as you all know, yesterday we had our briefing on revenue estimates, which was very sobering news. Unfortunately, seeing an additional $250 million write-down. So, in that context, if we aren't going to make really significant and in many cases devastating cuts to important programs and services, we do need to be looking at how we are going to continue to pay for them. So in light of that, we want to take a closer look at some of the revenue generating bills that have been proposed. So these are all bills that we heard in committee, but have not yet had a chance to really discuss as a subcommittee. So want to start that discussion today. And I think we'll start off with House Bill 754, which is Delegate Wells's bill to repeal the trade-in allowance on the vehicle excise tax. Delegate Wells, I don't know if you want to say anything to start, or I will just, if you want to sort of remind folks about the bill, and then we can just open it up for questions and comments.
Sure. So as folks know, this bill is for the trade-in allowance that we currently have. It's only at dealerships, right, that this is given to folks. And I think the other thing that is just important to note is that it's a one-time that is paid, in terms of it's not like an ongoing tax that people pay every year. It's a one-time thing at time of purchase. And it's going to provide some really valuable revenue for transportation, as we know that we sorely need. You're on mute, Madam Chair.
Thank you. Thank you, Delegate Wells. Any questions or comments to get us started? I see Delegate Hartman has his hand raised. Delegate Hartman, please go ahead. Whoops, we lost Delegate Hartman. Okay. Delegate Polakovich-Carr.
Thank you, Madam Chair. And maybe this question is for Delegate Wells, if she's able to answer it. So remind me, so this bill, most of the funding from this source goes into the Transportation Trust Fund. Is that right? It's dedicated transportation revenues. Is that right?
Yes.
Okay, thank you.
Hopefully Delegate Hartman can join us again, because I know he was trying to say something. We'll see. I know he had some concerns about this one. Any other? Oh, there you go. Let's let him back in. Oh, Delegate Polakovich-Carr, did you have something else to?
I was going to say, actually, I'll defer to Delegate Hartman, since I'm taking a second bite at the apple, and it looks like he's back. So we'll let him go first.
Okay, great. Thanks. Delegate Hartman, go ahead.
Thanks, Lana. I'm sorry for the interruption. The concern I have with this is, when we trade in the vehicle through a dealership, you're actually creating another product that's sold in tax. So there's nothing that, in my eyes, that's lost. It's actually a gain to the state, simply because that vehicle that's traded in is usually cleaned up, new tires put on it, and then resold at a higher rate, a markup, which gets a higher amount of tax for the state. So by encouraging more frequent trade-ins with this allowance, we're actually, I think, increasing the sales tax to the state in this category, and then also creating additional tax through compensation to the car salesman and everything else included. So I just have concern with us taking this away. I think is actually going to be detrimental to the tax category and to all the compounded benefits of tax that we get through the higher payroll and all the money that people can spend that, the additional income they're earning.
Okay, thank you, Delegate Hartman. Delegate Palakovich-Carr, you had another comment or?
Not related to that directly.
Okay.
I just remembered from the bill hearing that there was the potential for a sponsor amendment, but I just wanted to weigh in with my 2 cents that I actually like the bill better as introduced, for whatever that's worth.
Okay. Okay. And Stan, is there anything from the I guess I'm wondering about the point Delegate Hartman raised. Is there any data on sort of anticipated impact in terms of number of transactions? I guess I know Delegate Hartman and I have discussed this previously. I hold on to my cars a little longer than he does. But do we think, is there anything to suggest sort of that how consumer behavior would change? I don't know that we've seen any sort of real data on that.
Yeah, I think the fiscal note writer may have taken that into account in some fashion, but I would have to follow up with her to see if she has some information on that, and I'm happy to do that.
Okay. Okay. Any other questions, comments, concerns about this bill?
So,
Delegate Hartman, go ahead.
thank you. As you know, I lost connection for a few minutes, and then I heard something about the way the bill was introduced. Has there been any changes to the bill since it was proposed, or are we looking at the same bill or anything different?
I don't believe any amendments have been proposed. Is that correct, Stan, or do we have some that?
Well, Delegate Wells did introduce an amendment. And that one was essentially if you're trading in to get an electric vehicle, you would still get the trade-in allowance. If you're trading in to get a hybrid vehicle, you'd get 25% of the trade-in allowance. And if you're trading in to get a gas-powered vehicle, you would get no trade-in allowance.
Okay. And that amendment was actually filed. That amendment was submitted. Okay. I apologize. I remember the discussion of it. I didn't see the amendment. Okay. Okay. So Delegate Palakovich-Carr, that's the amendment you were referring to earlier. Is that correct?
Yes, and I actually haven't seen the amendment, but Stan, can you clarify, are there any dates that are included for that, or it would just keep electric vehicles with the exemption for perpetuity, or is there some sunset on that?
No, perpetuity. Yeah, all of those rules would just continue indefinitely.
Okay. I'd say one, I totally understand where the sponsor amendment is coming from, because we are trying to incentivize people to move to cleaner vehicles, and that is very important. But I looked at, where, say, the federal government goals are for electric vehicles. And I mean, the Biden administration it's still a proposal, but has proposed that at least 54% of new vehicles sold in the US by the year 2030 be electric. So I guess I'm a little bit just concerned about, like, we know electric vehicles are on the rise. It's an uptick. That's a good thing. We want to keep making sure that happens. But I think at some point, in terms of what the fiscal impact is to the state, we would see decreasing revenues then to the Transportation Trust Fund. So again, I kind of like the bill better as originally introduced, but if we did go the route with the amendments, would just say that maybe we stop that in after a certain number of years,
Right.
or ramp it down.
Right. No, I think that's a good point, Delegate. I mean, I believe the incentives around electric vehicles are really were designed to sort of help this new piece of the industry get a foothold and grow and come sort of up to scale. And so I think your point is well taken, that the incentives should be about sort of helping that process along, not simply a bonus because you bought an electric vehicle, right? So as folks are making those decisions, okay. Delegate Roberts.
Okay, thank you, Madam Chair. I guess I'm just a bit confused because, like, we don't have the ability to see the amendments that were submitted, right? Oh,
So I should just correct myself earlier that the amendment was drafted, but I think it may never have been formally sent to the committee and distributed to the members. But
Got it. Okay.
I can send that around to the subcommittee if you like.
Okay.
Okay.
Yes, please. I think that'd be helpful.
And I also wanted to know if Stan could repeat the answer to the last question, because right when he said it, I was getting ready to ask, but I didn't want to be out of order.
What was the question that you're referring to?
It was really the amendment.
Oh, so you
On the
just
amendment.
The details of the amendment.
Yes.
the amendment. Oh, okay. Yeah, so the amendment is just that if you're trading in to get an electric vehicle, you would still keep the full trade-in allowance. If you're trading in to get a hybrid vehicle, you'd get 25% of the trade-in allowance. And if you're trading in to get a gas-powered vehicle, you would get no trade-in allowance.
How does the allowance work?
Basically, the value of the vehicle that you're trading in is subtracted from the value of the vehicle that you're buying for purposes of calculating the tax. So for example, if you're trading in a $10,000 vehicle and the vehicle you're buying is $30,000, you would subtract the $10,000 from the $30,000, and then the tax is imposed on $20,000 rather than the full value of the vehicle that you're buying.
Okay. Okay. Thank you.
Okay. Any other questions or comments on this bill? I appreciate everyone, talking through their thoughts. Okay. All right. Well, seeing none, I'm going to say let's move on to the other bill related to the vehicle excise tax, and that is House Bill 925. And this was Delegate Fair's bill that he presented to us, and this simply raises the rate for the excise tax from 6% to 6.5%. So pretty straightforward, but just interested to hear folks' thoughts or any questions you may have. Delegate Hartman.
Thanks. Trying to unmute. So I spoke to the folks at Preston Ford today. They own 11 dealerships in Maryland. They feel that either of the bills would be detrimental if the two bills were compounded and both put in place. I think they would have grave concern as to the impact that would have on business. And then hearing the amendment on the previous bill with the incentivizing electric vehicles, it seems that, car sales have kind of plateaued in electric vehicles. And one of the problems our Maryland businesses are having, our Maryland dealerships are having, is with the allocations of electric vehicles, they can't sell them. So if we add on top of that, taking away the credits and the extra tax, they're getting the electric vehicles on the lot, especially in the rural areas. But talking to the governor's office, they're hearing that, electric vehicle sales are kind of, hitting some stagnation for many reasons. So just sharing concerns on the consideration of the two.
Okay. Well, let me ask you this, and I'm guessing it's not well, I understand that the dealers oppose either of these and feel that both of them together would be sort of a compounding challenge. In your conversation, was there one or the other which was less objectionable from the dealer's perspective?
No, I didn't pose that question to them. I can certainly reach out to a few of the large automotive groups, and when this conversation comes up again, I can have the answer for you.
Okay, just curious about that. Thank you. Delegate Wells.
I was just gonna add, at the hearing, they all said they liked Fair's bill better.
Oh, okay.
I don't know if they
Sorry,
remember that. They just said this was a better bill. That's all. I
less,
vividly remember that after my bill hearing, so.
Got it. Okay. Delegate Palakovich-Carr.
Thank you, Madam Chair. I mean, to that note, though, this bill does raise like half the amount of money.
Right. It's less revenue, so that's probably why. Right.
Yeah. But I mean, we need all the revenue. So Transportation Trust Fund is really, really hurting right now. And it's going to start taking its toll in terms of, no pun intended, toll on our transit systems and roads.
Okay. Any other questions, comments? Okay. I guess that concludes our vehicle excise tax conversation. Stan, thank you very much for joining us. You are most welcome to stay, but you may have other things pressing on your agenda this afternoon. But thank you.
Thank you, Madam Chair.
Okay, moving on to House Bill 1007. This is Delegate Palakovich-Carr's Fair Share for Maryland Act. Delegate Palakovich-Carr, do you want to start us off?
Sure. I can just remind folks of what's in the bill. So HB 1007 includes a number of potential revenue raisers for the state, as well as tax cuts through expansions of the Maryland Child Tax Credit and Earned Income Tax Credit. On the revenue side, it includes worldwide combined reporting, the throwback rule, which is another corporate tax loophole that we'd be closing under the bill, changing the threshold on the estate tax, closing the LLC loophole, another corporate tax loophole. On the individual income tax side, does create some new high income earner tax brackets and has a surtax on capital gains. think I've hit all of the major points there. And I will just note that we do have a couple of folks who have some more expertise who have joined if there's particular questions. So Michael Mazeroff from the Center on Budget and Policy Priorities and Callie Schumitz from the Maryland Center on Economic Policy who can help field if there's technical questions about anything. Oh, and one last piece, because this has come up in some offline conversations with colleagues since the hearing. Our analysis is that the bill generates 1.6 billion a year. The fiscal note came in a little lower than that because the fiscal note writer did not include the revenue generation for two of the main pieces in the bill, closing the LLC loophole, and I'm forgetting what the other one is off the top of my head, capital gains surtax. We have asked for a revised fiscal note, but don't have that in hand at this point.
Okay. Okay. Any questions or comments to get us started on this? Would it be helpful to just sort of in the conversation, just to go through the different components? Delegate Young, I don't see a hand, but I did see you unmute. Did you want to say something?
I thought about it, but since you saw it, I will go ahead and just say I think it would be helpful to walk through the bill. I mean, it's a big bill. I do think JPC delegate, you've given a great overview, but you know, it's just a lot to digest.
Okay. All right. Okay. So George, then I'm gonna ask you to kind of walk us through, and you can start wherever you want. I was kind of looking at the fiscal note, and we can follow along in that order, or if you prefer something else, that's fine.
Okay, I believe that the fiscal note generally tracks most of the order in the bill, but let's see. The first provisions that are in the bill pertain to the estate tax. Those are the changes to section 7-309. Currently, there's a $5 million exemption from the value of the estate from the application of the estate tax that can be increased through the use of portability, in which case the unused amount of the estate tax for a deceased spouse may be then taken into account when calculating the estate tax for their for the second spouse. House Bill 1007 would reduce that amount from $5 million to $2 million for individuals who die on or after January 1st of 2025. Those provisions effectively apply through, can be seen through, like I said, from pages 3 to 5. On page 5 through the top of page 8 is a corporate income tax provision alteration. This is the throwback rule. Currently, because of the way that taxes are calculated, if the sale is not taxed here, would be potentially taxed in another state. If that other state doesn't tax it, that's effectively referred to as nowhere income. For purposes of calculating corporate income tax for this state, it would pull or throw that nowhere income back into the calculation of the Maryland corporate income tax. That would apply for taxable year 2026 forward. The next provisions in the bill begin on page 8 and carry on to page 9. Those would apply an additional 8.5% tax on distributed shares from PTEs that would exceed $1 million. And the tax rate would be at 8.25%, which is akin to the corporate income tax rate. On page 9, you have alterations to Maryland income tax brackets. Those would apply in taxable year 2027. On page 10, you see the additional 1% tax related to certain capital gains income. It does exclude certain capital gains, those attributed to selling a dwelling, to certain holdings within retirement accounts such as 401ks, 403bs, 457bs, 408s, Roth IRAs, defined contribution plans, among other specified income. Beginning on the bottom of page 11 and carrying through the top of page 15, you see provisions related to the earned income tax credit. Those provisions would provide enhanced credit for individuals without qualifying children. Beginning on page 15 and carrying on to 16 are the alterations to the child tax credit to make that more generous. And then lastly, beginning in section 3, you have provisions related to combined reporting. And Madam Chair, I don't know if you want to now take if there's any particular sections that members have questions about.
So, yes, and I see Delegate Roberts already has a hand raised. Go ahead, Delegate Roberts.
Thank you, Madam Chair. So, George, that was just like a whole mouthful and then some of information. And you even used like some acronyms that I wasn't really familiar with. But I'll start with the last thing that you just talked about, which was the child tax credit being more generous. And I'm just looking at page 15. So, it kind of, maybe, I'm not sure. I'm looking at page 15 of the bill. Should I be looking at the fiscal note so that I can feel like I'm reading English, or?
So page 9 of the fiscal note discusses the alterations to child tax.
Okay. So I need to be on the fiscal note because I was looking at the bill.
That'll probably help you out a lot more.
Okay, thank you. Okay. I was trying to follow, but.
Pretty much one of the more significant changes would be is that currently eligibility is limited to certain dependents, either those who are under age 6 or if the child has a disability, those who are under age 17. This would increase that to any dependent who's under the age of 18. In addition,
increase it from 500 to 750?
That's the actual amount of the credit.
And
that is also being increased.
From 500 to 750?
Correct, if the qualifying child is under the age of 6 years.
Okay. And then?
Another expansion of eligibility relates to the income of the parents, because currently it's limited to taxpayers who have a federal adjusted gross income of $15,000 or less. And this increases that eligibility as well. Increases those exclusion amounts for income.
Okay. Yeah, I should have started with the fiscal note. Okay, that's
always a good place.
Okay, yeah.
I said always a good step.
Yeah. I'm gonna hold my questions for some of my questions.
Okay.
Real quick.
Okay. Thank you, Delegate. Any others? George, I had one. So on the combined reporting piece, so the House approved a combined reporting bill previously, correct?
That's correct.
When was that? A few years ago?
That was in 2020.
2020, okay. And how does that bill compare to the combined reporting provisions in House Bill 1007?
There are two main differences. The first is that under the previously introduced or considered or approved version of combined reporting, that allowed for election of calculating corporate income tax using the water's edge method. So in that instance, you'd only be focused on those corporations that are incorporated in the United States, or those generally having significant United States presence, for determining whether or not they will be included in the combined group for combined filing purposes.
Okay.
And then one of the other differences was the inclusion, and unfortunately I don't have it immediately before me, but a provision related to deferring tax effectively on certain, or providing a subtraction modification, a deduction for certain deferred tax assets or liabilities. That type of provision has been included in several other states that have adopted combined reporting. And it's varied as far as their approach, as far as the duration of those periods of time. But as an example, Connecticut, Massachusetts, and New Jersey have included deductions for those types of tax assets.
Delegate Buckle.
Thank you. George, has any other state, to your knowledge, ever done this worldwide? I mean, we know that there are states that have combined reporting for U.S. domestic entities or subsidiaries, affiliates, however you want to view it. Has any other state ever tried to capture worldwide combined reporting income?
To my knowledge, no. Other states have considered the approach, and Delegate Polakovich-Carr might be able to speak more specifically as well.
Okay. Delegate Polakovich-Carr.
Thank you, Madam Chair. I was actually just going to ask if Mr. Mazeroff could weigh in on that, because my understanding is that other states do have either optional worldwide or have mandatory reporting for certain income from other countries, but he can, I think, add more detail to that.
Okay, Mr. Mazeroff, please.
Yes, thank you. So, I mean, worldwide combined reporting is not a new idea. In the early 1980s, until from about the mid 1970s to the early 1980s, there were 12 states that required worldwide combined reporting, and that was a majority. I mean, that was a large majority of the 15 states that required any form of combined reporting. So at that time, there were about 15 states that required combined reporting. 3 of them were Water's Edge, and 12 of them were worldwide. After the U.S. Supreme Court upheld the constitutionality of worldwide combined reporting, the Reagan administration put pressure on the states to withdraw its Water's Edge combined reporting, which all of them did except for Alaska. So Alaska still has worldwide combined reporting for oil companies. And then there are 10 states that allow an election between worldwide combined reporting and Water's Edge combined reporting. And we've recently been collecting data on the number of corporations that are electing to file on a worldwide combined reporting basis. And there are a non-trivial number of companies that are making that election, because some companies actually do pay less.
Well, that's what I would say, Mr. Mazeroff, is, why would the company elect worldwide if they were going to pay more taxes? So if you make it optional, it would suggest to me that they would have their accountants run both numbers, and whatever the smallest one was, they'd elect to use that, which would kind of defeat the whole purpose of it from a
it would
revenue generating standpoint.
Well, there are certain companies that pay less, and the numbers that we're collecting are that in in most states, there are probably, 12 or, 10 or 15,000 companies that are in those states that allow an election. The relative numbers of orders of magnitude are there, 10 to 15,000 companies that are choosing to file on a water's edge basis because they would pay more under worldwide. And we're finding basically that on the order of 100, in most of the states that we've looked at, it's generally on the order of about 100 companies that are paying less under worldwide, and that's why they're choosing to file that way. So, but yes, there are, as has come up in the hearing, the hearings over the years, there are some companies that pay less under worldwide combined reporting, and that's just fine. But to me, that indicates it's a sort of neutral tax policy. Some companies do better, some companies do worse, and that's fine. The reason why, other states that have looked at the revenue impact of this conclude it raises revenue is because there is so much international profit shifting going on that the companies are pay way more than the companies that are paying less.
The other question I would have, whoever can answer it, are there any states that we're aware of that have a higher corporate income tax rate, the same or higher than ours, that do combined reporting? So I know there are a lot of states that do combined reporting. Are there any that have an 8.25% or higher corporate income tax rate and do it?
I don't have that I don't have that immediately at my hands. I can probably get that for you in the next 5 or 10 minutes. I just need to
That's
go
fine.
on.
I mean,
But
don't
yeah,
think we're going to
I'm
today.
very confident. I'm
Right.
very confident that there are states with higher corporate income.
I mean, I'm going to
tax
bet
rates.
it's California, New York, Massachusetts, but that might be.
I mean, I'm almost positive Minnesota does. I think New Jersey's corporate tax rate is still higher than that. So yeah,
Illinois as
I'm
well.
confident that there are some states that do water's edge combined reporting and that have higher corporate.
And that's
income
all
tax
I would
rates.
say, that like California, New York, Illinois, New Jersey, they're not doing very well in terms of their net population loss, their net GDP loss. They're all states that are losing the competitive game of states in terms of job creation, and they all have massive budget problems. California, New York in particular have budget problems that make ours look like child's play. And yet they impose these things. They have very high tax rates. They have corporate reporting. They have whatever. It's not solving their budget problems. And so I just leave it at that. I know we're not voting today, so I do appreciate the information, Mr. Mazeroff. You're certainly a wealth of knowledge about the topic, and I appreciate the good faith sharing that with me.
All right, thank you. Delegate Palakovich-Carr.
If I can, thank you, Madam Chair. If I can also just ask Mr. Mazeroff to clarify about the states that have combined reporting and that do require reporting of certain international income that would otherwise be in tax havens. Do I remember that correctly? I feel like DC and maybe some other jurisdictions have not just water's edge, but some additional mandated reporting.
Yeah, that's true. There are, I think, at this point, 6 or 7 states that have sort of taken an interim step between water's edge and worldwide by requiring the inclusion in what would otherwise be water's edge combined reports of subsidiaries that are doing business or that are incorporated in sort of, pretty infamous or well-recognized low tax foreign countries, like Bermuda or the Cayman Islands. So there are some states that are sort of midway between water's edge and worldwide. And then there are a lot of states there are other states that are including other forms of foreign income in the tax base, like the global intangible low tax income that's calculated under the changes that were made to the federal tax system during the Trump administration in 2017. So, but yeah, there are, I think, as I said, 6 or 7 states, the District of Columbia definitely being one of them, that include tax havens in what would otherwise be considered water's edge combined reporting.
Thank you. Any other questions or comments? I had one question, George. You mentioned in comparing the previous bill to this one on combined reporting, you mentioned the water's edge worldwide difference, and then there was also the piece about sort of deferring certain deductions. Can you speak more to that piece?
Yes, the bill included a provision to allow subtraction modification for what was defined as net deferred tax assets and net deferred tax liability. Net deferred tax assets are those assets that exceed deferred tax liabilities of a combined group, computed in accordance with generally accepted accounting principles. Net deferred tax liabilities are those deferred tax liabilities that exceed deferred tax assets of a combined group, computed in accordance with generally accepted accounting principles. The bill would have allowed either members of a combined group that are publicly traded or affiliated with a combined group that was publicly traded to be able to deduct those amounts from federal taxable income of the group when determining Maryland modified income for the combined group under certain circumstances.
Okay.
And then they would be allowed to claim that over a period of time. Generally, it was in the bill, it was they could, of that amount, they would claim 1/10 of it over in each of a period of 10 years, over each year over a period of 10 years.
Okay. And so that was in the prior bill, but not in this one.
That's correct.
And I see Mr. Mazarov has his hand raised. Did you want to speak to this point?
Yeah, if I could.
Thank you, please.
Sure, I just wanted to sort of clarify this because this committee has sort of heard this issue in the past couple of years as well. So what this is about is that publicly traded corporations that have something on their books called the best example, I'll just do it with deferred tax liability. If they have taken accelerated depreciation to calculate their taxes, which is a tax break, it allows them to sort of bunch into early years the value of what the equipment that they're buying. If they take accelerated depreciation, they're still allowed for tax purposes, they're still allowed for financial accounting purposes to basically make their profits that they're reporting to shareholders look larger in those early years by pretending that they wrote off the equipment less quickly. And when they do that for accounting purposes, that puts something on their books that's called a deferred tax liability. It basically is sort of signaling to shareholders that, well, yeah, our profit only looked X amount this year, but it's sort of exaggerated because, and if you're thinking of looking ahead, because down the road, we're going to actually be writing off less than we otherwise would have on our financial statements. And so accounting principles also require them when their effective tax rate, corporate income tax rate goes up at either the federal or the state level, then they have to make a one-time adjustment to the value of that deferred tax liability. They have to increase it, and that requires a write-down on their financial statements in the year that increase in their real tax rate occurred. And so basically, publicly traded companies are saying, well, combined reporting raises our tax liability, which in and of itself is an acknowledgement that it raises their tax liability, that it doesn't, for most of them, it doesn't reduce their tax liability. But what they're saying is if you enact combined reporting, it increases our real tax liability, and it also requires us to report lower profit to our shareholders because we have to make this one-time adjustment to increase the amount of deferred tax that we're showing on our books. So they're saying we get hit twice when you in two ways when you enact combined reporting. Our real tax liability goes up, and then we have to tell our stockholders that our profit is lower. And so they're saying we think you ought to give back, allow us to give back a deduction to us to offset that second impact. And so that's what that deduction in earlier versions of the combined reporting legislation was intended to do, was to mitigate that double impact. And indeed, some of you may recall that elements of the business community in 2019 and then again in 2022 came to this committee proposing you considered legislation that also would have done this as a result of the increase in their tax liability that occurred when you enacted single sales factor apportionment. Because again, same effect, single sales factor apportionment increases the tax liability of some companies, and they asked you to enact legislation to enact this same kind of deferred tax deduction to offset the impact of single sales factor. And in both 2019 and 2022, that legislation was not enacted.
Okay. So, so this is intended to be what was in the previous bill that is not in this bill. It's intended to be a little bit of a relief valve in terms of the impact of combined reporting. Now, I guess my question for George, or maybe Delegate Palakovich-Carr as the sponsor, you may have a better recollection. I'm just wondering, in terms of testimony we heard on this bill, House Bill 1007, I recall opposition to combined reporting. Was anyone asking for this measure?
Not that I can recall.
Not that I can recall either.
Okay. Okay. All right. Any other questions or comments? Okay, we've got not seeing any, although Delegate Buckle just turned his camera back on. Are you getting ready to speak?
No, we're not voting. Is that correct?
We are not voting. We are not voting. This is
No.
this is really just to because
No.
it, because these are pretty hefty bills, and it's been a little while from the hearing. Just wanted to make sure we had a chance to really discuss and give folks a chance to revisit them and see what questions or comments there may be. Mr. Mazarov, was there something else you wanted to add?
If you'll indulge me, I also just wanted to give a little technical adjustment or technical correction with respect to the throwback rule, just to sort of clarify what that is.
Sure. Very briefly, please, because I know folks are we're coming up on an hour here.
Very briefly, I mean, the throwback rule basically just deems a sale that is made into a state in which a sale shipped out of Maryland, delivered into a state in which the company is not taxable. It deems it for apportionment purposes to be a Maryland sale, for corporate income tax apportionment purposes. And so it's often mischaracterized as basically saying that, like, if a Maryland corporation sold into Nevada that doesn't have a corporate income tax, that sale automatically gets thrown back to Maryland. And people say, well, that's not fair, because just because Nevada doesn't have a tax shouldn't mean that Maryland should get to put that in its apportionment factor numerator. But that's not how it works. If that corporation had a physical presence in Nevada and could be subjected to a corporate income tax in Nevada, that sale doesn't get thrown back. The sale only gets thrown back if the corporation is not taxable in the state in which the product is being delivered. So I just wanted to clarify that.
Got it. Okay. Thank you. Thank you. Okay. Any other questions before we call it a day? All right. Well, seeing none, thank you all for your time. We do have, please be prepared. We will probably be meeting at least a couple times next week, as crossover approaches. So, thank you all.